Welcome to The Best Investment Writing, your gateway to the minds of the world's most respected investors. Join us as they unveil the insights gleaned from their tireless research, providing you with invaluable perspectives to enhance your own investment journey.
All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
My name is Steve Ho. I'm the co-head of Equity Index Research at Bloomberg Index Services Limited, or simply Bloomberg Indices. Bloomberg Indices has had a proven track record in creating industry-standard bespoke benchmarks across asset classes as well as innovative strategy indices utilizing Bloomberg's proprietary data. So I am part of a research team that works to support Bloomberg Indices by creating new products through novel research and providing investor education. Check us out at bloombergindices.com. Today, I want to tell you about a new and exciting piece of research that we've been doing recently on the topic of pricing power. Pricing power has been top of mind for investors in the last couple of years, and we believe it will remain relevant in the coming months as well as the global economy wrestles with a new reality in the post-COVID era. So Warren Buffett once said, "The single most important decision in evaluating a business is pricing power. If you've got the power to raise prices without losing business to a competitor, you've got a very good business. And if you have to have a prayer session before raising price by 10%, then you've got a terrible business." So pricing power is one of the most frequently mentioned concepts in the business world. Intuitively, investors love companies with pricing power because it implies that firms have the strong ability to maintain and grow their profits. With the return of inflation to the global economy after lying dormant for over a decade, the concept of pricing power was once again top of mind for investors seeking to identify companies resilient in this new environment. Since 2002, Bloomberg data shows that pricing power as a concept has been regularly mentioned in the transcripts of public company earnings calls and shareholder meetings, and from 2020, mentions of pricing power have particularly surged alongside of mentions of inflation itself. Now, despite the frequency of these frequent mentions, many struggle to provide a clear definition for the concept of pricing power, let alone an easy way to measure it. In this episode, we will present a straightforward framework for capturing pricing power systematically. We argue that the stability of gross profit margins is a simple and robust metric for identifying companies with the ability to raise prices. Moreover, we found that companies as identified by our measure of pricing power have significantly and consistently outperformed the broader market over the past 15 years, with lower volatility and smaller maximum drawdowns. We will further show that the outperformance of the pricing power factor extends beyond the US and various global markets with similar characteristics. We analyze the nature of these so-called pricing power companies and why they may have outperformed over the long run. Pricing power companies tend to be less glamorous, newsworthy, but instead they are quiet, stable quality compounders. So from a style factor perspective, pricing power companies tend to have a quality, low quirk volatility type of characteristic. Contrary to conventional expectations, pricing power is not a factor that only performs during inflationary period, but remarkably is a factor that has remained robust and consistent through both inflationary and non-inflationary regimes. And if the listeners will turn to the actual paper that we have posted to the link included in the bio, you will see the performance of pricing power index that Bloomberg has constructed and how it has performed over the last 15, 16 years. Now, pricing power fundamentally is really about profit margin stability. We'll begin by describing our measure of pricing power. As mentioned previously, while the idea is frequently referenced, the concept is actually rarely precisely defined or empirically measured. People often casually associate pricing power with highly profitable companies or those that they perceive to have strong market power. Following such logic, one might try to screen for companies with high profit margins or even collect data on market shares or demand elasticities, if you are so arcane. But in the case of the former metric of profit margin, it turns out pricing power is not well captured by the level of profit margin because high profit margins can be eroded or conceded when input costs rises. In the latter case, it will be quite onerous, if not outright impossible, to collect data all public companies in terms of their market power or price elasticities in response to demand. Now, we argue that the stability of profit margins, specifically gross profit margins, is a simple and effective metric to systematically identify companies with pricing power. Intuitively, if a company has pricing power, then when costs increase, it should be able to pass them on to consumers by raising prices, thereby maintaining the same profit margin. We focus on the gross profit margin instead of the net profit margin because we believe that the gross profit margin can most accurately capture margin variations due to input cost changes. Net profit margin, which is often the first measure one thinks of to capture corporate profits, can be and often is manipulated to smooth earnings from quarter to quarter. There are simply too many cost items with flexible accounting treatments, shall we call them, that are often honestly quite discretionary. On the other hand, gross profit margin is simply the difference of the top-line revenue and the cost of goods sold, COGS. COGS typically capture both variable physical inputs and hourly wages for temporary labor input. By being the closest line item to the top-line revenue, it leaves much less room for manipulation and most directly reflect companies' ability to pass on costs. Specifically, we define pricing power as the inverse of the standard deviation of the trailing 5-year 12-month gross margins. The formula is in the paper. To calculate this metric, we require the company has at least 5 years of gross margin history. This requirement does, of course, have certain restrictive implications. We will not be able to calculate a pricing power metric for companies that are younger than 5 years. We believe the loss here is relatively small since it's quite unlikely that a young and probably growing public company commands significant pricing power. We also leave out some financial firms for which gross margin is not applicable. This is especially the case for banks. Generally, we do not believe bank products can really compete on the prices of their products anyway. Now, pricing power factor has actually offered a very strong performance in the US. Since pricing power is such a pervasive concept, there are good reasons to expect that it's already priced in, quote unquote, by the market, therefore does not offer consistent outperformance. However, it turns out companies with strong pricing power, as measured by our metric, have historically earned consistently strong returns while simultaneously maintaining a lower risk profile. Moreover, they have demonstrated similar characteristics across different geographical markets, lending credence to the long-run reliability of pricing power as an investment factor. We can begin by looking at the performance of a portfolio of pricing power companies in the US. The Bloomberg Pricing Power Index, ticker BPP-US Index Go on the Bloomberg terminal, selects US large and mid-cap companies with at least 5 years of gross margin data, as we mentioned before, and those that have been consistently profitable for the trailing 5 years with positive net profit margin. We proceed to keep all the stocks in the top 90th percentile of each sector by the lowest debt-to-asset ratio. And finally, we pick 50 stocks with the lowest standard deviations of the trailing 5-year gross margins. This index is equal-weighted and rebalanced quarterly. We describe the index construction in greater detail at the link inside the paper that's on our website. So as shown in Figure 1 and Table 1 that are in the paper, since 2007, the Bloomberg Pricing Power Index has consistently outperformed the underlying benchmark, the US Large Mid-Cap Total Return Index, which is similar to the S&P 500 in terms of levels, while realizing slightly lower volatility and lower drawdowns, both common measures of risk. Generally, the pricing power factor has realized a lower than 1 market beta, therefore realizing a significantly positive CAPM alpha. As seen in the second figure in the paper, this outperformance is actually quite pervasive. It does not come from a particular year. In this second chart, we show you the year-by-year return comparison. So instead, over the past 15 years, the pricing power index has outperformed the US Large Mid Index in both up and down years, by rising more in up years and not falling as much in down years on average. Another striking factor is the performance of the pricing power index during the times of great economic turmoil and macroeconomic uncertainty. As a result of the global pandemic and the ensuing monetary and fiscal stimulus in September 2020, the US has experienced a rapid surge, the likes of which we haven't seen in nearly 40 years. As a result, in March 2022, the Federal Reserve started raising funds rate, its key policy rate, at the fastest clip on record from around 0%, 0.25 bips to 5.5%, causing one of the sharpest sell-offs in equities and bonds in over a decade. So the third figure in the paper shows that the Bloomberg Pricing Power Index has performed resiliently during this period, has held up better than the benchmark, and has also rebounded more sharply. One way to interpret the relative performance of the Bloomberg Pricing Power Index during this episode is that in the first half, where inflation rate was rising, all firms experienced an increase in demand, hence revenue from consumers are flush with cash. In the second half of the episode, starting in 2022, the Fed begins to raise interest rates and inflation begins to fall. Production costs have risen while consumer demand begins to slow or weaken, and companies with pricing power are therefore able to raise prices and maintain profit margins, while those without pricing power see their profit margins fall along with their earnings, hence a sharper drop in stock prices. If pricing power only worked well in the US from 2007 to 2023, it may very well have been a fluke and hence less persuasive. We reinforce our finding in our paper by assessing the performance of the pricing power factor in other global markets over a longer historical sample period. In fact, we look at from 2003 to the present day, that's just over 20 years of history, we find that pricing power factor has exhibited similar characteristics across different geographical regions. We assess the performance of the pricing power factor across global markets by constructing separate pricing power indices in a set of representative large economic blocks. Specifically, we consider 4 regions that are covered by the Bloomberg Equity Market Benchmark Indices. These markets are the US Large Mid-Cap Index, which I've seen before, the Bloomberg European DM Market Large Mid Index, or the EDM Index, the Bloomberg APAC Developed Markets Large and Mid-Cap Index, or APAC-D Index, and finally, the Bloomberg Emerging Markets ex-China Large and Mid-Cap Index, or EMXCN Index. We look at EM ex-China just because I think there's all sorts of reasons why, with the A shares and the special treatment through the Hong Kong exchange, that have led to, I think, recent period, a lot of differences. I think looking at EM ex-China is a little bit cleaner. So we chose these 4 regions so that they are reasonably large pools of securities with a similar number of liquid equities to choose from. Nevertheless, APAC-D and EMXCN indices have fewer securities than the US and EDM indices, especially in the earlier half of the sample. In terms of methodology, we follow the same steps as BEPP US index that we mentioned above. To allow maximum consistency on comparability, we modify the index selection rules slightly. Instead of requiring a minimum of $10 million of 90-day average daily trading volume, we require 2 million 90-day average daily trading volume and a minimum of 500 million total market cap. Further, instead of always picking the 50 stocks with the greatest pricing power, we select the top 2 quintiles of eligible companies with the highest pricing power. The pricing power indices are still equally weighted and quarterly rebalanced. In Table 2, we tabulate the performances of the pricing power indices across these 4 market regions. The results display a striking level of consistency and similarity. In all 4 regions over the last 20 years, from 2003 to 2023, each regional pricing power index significantly outperformed its respective underlying benchmark indices with lower realized volatility, lower maximum drawdown, and higher Sharpe ratios. The outperformance of pricing power companies is especially significant in European developed and emerging markets, earning over 2% and 2.86% of annualized excess returns. Adjusted for the fact that pricing power stocks have lower market beta and average annual excess returns are even higher. In both regions, pricing power indices have realized US level average annual returns, which go against the narrative that the rest of the world has uniformly underperformed the US over the past decade. In APAC developed markets, pricing power has realized the lowest outperformance. This is consistent with the existing literature that has documented generally weak historical performance of risk premium factors in Japan. In the figure 3 in the paper, we show that the outperformance of the global pricing power indices are distributed relatively evenly across time as well, just like as was the case in the US. For legibility in the paper, we only plot the annual excess returns of each regional pricing power index relative to their respective benchmarks. So the bar here that is above the dotted line means that the pricing power has outperformed the benchmark in a given year. And then, except for a couple big drawdowns in EM, ex-China, and APAC developed markets, most of the bars here lie above the dotted line, which demonstrates the consistency of the factor's outperformance. Pricing power has performed particularly strongly in Europe. Over the past 2 decades, pricing power indices have generally performed well together across the globe, only showing divergences starting in 2016. US and European pricing power indices have shown the most persistent benchmark outperformances, while APAC and EM ex-China have shown more volatile outperformances. The figure 3 clearly demonstrates that pricing power is not just an inflationary story. Pricing power indices have performed, indeed outperformed strongly over the past 20 years in both low and high inflationary regimes. Taken together, we can comfortably say that the outperformance of pricing power as a factor over the past 20 years has been robust, consistent, and unlikely to be the result of a sample selection fluke. This brings us to an even more interesting question: what explains the outperformance of the pricing power factor? So we seek to address this question in the paper by looking at factor attribution. So in particular, to understand the sources of pricing power index outperformance, we will leverage both quantitative and qualitative analysis of the pricing power index holdings. From a quantitative angle, we'll apply a factor-based attribution of the excess returns of pricing power indices to help us understand the sources of its returns in terms of known factors with risk premium. We follow the price-based return and attribution with a qualitative look at the types of names that are held in the pricing power index. Between these 2 types of analysis, we hope to paint a clearer picture as to why we think that the companies with pricing power may have outperformed over the long run. So we start with factor-based return attribution of pricing power index excess returns. Factor-based attribution helps us understand the sources of relative performance of a strategy by decomposing returns of a strategy, or in this case excess returns relative to a benchmark, into the returns of its exposures to various style factors and industries. To conduct this exercise, we utilize Bloomberg's market-leading 3rd-generation factor risk model, multi-asset class, or MAC3 model. We start by looking at the style factor exposures of pricing power indices in the 4 different geographical regions. Specifically, we look at active factor exposures, or the factor exposures of the weight differences of each regional pricing power index and its parent selection universe. Overall, the 4 different regional pricing power indices have similar factor exposure profiles. They are smaller in size, company size, have lower market beta, they have higher quality in terms of high profitability, low leverage. They have higher growth and lower value. It is worth noting here that MAC3 risk models, generally we order from high to low. So when people look at the chart, size is, for example, order from bigger to smaller, which is perhaps not people sometimes are used to in terms of the direction of the sign of the risk premium. All in all, the factor exposure patterns of the regional pricing power indices are highly consistent. The negative size exposure, of course, reflects the fact that we have an equal weighted construction of the indices. By selecting profitable companies with lower standard deviations in their gross margins, we expect they will be more profitable and have lower volatility due to lower volatility of the fundamentals, which in this case are profit margins. There are some other elements that are particularly noteworthy. Pricing power companies do not have lower idiosyncratic volatility. Instead, their lower volatility comes from having lower market beta. Another fact worth emphasizing is that pricing power companies are not value companies. Instead, they tend to command higher valuation as quality compounders. Pricing power indices have an interesting mix of style factors in this case. Quality, growth has not cheap or low in value, and lower beta. This risk created by relatively high valuation in a valuation compression environment is compensated by a lower market beta exposure, as evidenced in the 2022 market sell-off. On the other hand, the low market beta is offset by modestly higher growth. In fact, these factor exposures of pricing power indices mirror the modern investment style of the famed investor Warren Buffett that we mentioned at the beginning of the article. A 2018 AQR Capital paper, I think the paper is called Buffett's Alpha, they found that systematic exposures to quality and low beta factors explain most of Berkshire Hathaway's outperformance over S&P 500 over the long run. Contrary to his reputation as a pure value investor, Buffett's investment style in recent years has moved away from picking up cigar butt towards quality and low beta. Apple is a perfectly good example of this style of investment. I think Costco is another good example for that matter, which is also featured in our pricing power index. From an industry exposure perspective, pricing power companies have had consistently high exposure to industrials, consumer staples, consumer discretionary sectors. It should be unsurprising that we find many companies with pricing power in these sectors as they tend to be suppliers of hard-to-substitute input to firms and consumers. These customers tend to accommodate the cost increases for these suppliers' products while cutting down expenditures in other categories. The low exposures to financials reflect that many financial firms, such as banks, do not have well-defined gross margins. Now, to understand the sources of outperformance, we can decompose the cumulative total return of the regional pricing power indices into returns that are attributable to different style factors and industry exposures. From 2007 to 2023, all 4 regional pricing power indices that we have constructed outperformed their respective benchmark indices that we have shown before. In each case, the significant amount of return outperformance is attributable to the sum of style factors and sum of industry exposures. However, we also know that there is a sizable, persistent quantity of returns that is not attributable to either style factors or industry exposures. This suggests that perhaps pricing power captures additional sources of alpha that have not been fully captured by traditional factors. The quantitative analysis through equity factor lens already makes a very clear suggestion for the profile of companies that are often held in the pricing power index. We want to now take a more qualitative look at the companies that are most consistently featured in the pricing power index. So in table 5 of the paper, we list the top 20 companies that have most frequently featured in the regional pricing power index. Pricing power companies are not glamorous names that regularly occupy news headlines such as Tesla, Amazon, or even Apple. Instead, they tend to be companies that are niche suppliers and have strong and steady earnings, cash flows, and very stable profit margins as they pass on cost increases. So in the US, we notice that pricing power companies tend to come from consumer staples or specialized industrial suppliers. Good examples here include Costco, Pepsi, Eaton, or AutoZone. If we look at the rest of the table, we see that the rest of the regions in Europe, for example, we see a similar pattern. But instead of seeing American sort of industrial suppliers, we see luxury companies such as Louis Vuitton, L'Oréal, which are all regularly featured. These are Europe's quality growth companies. It's interesting to note that our pricing power signal can pick up such regional specialty automatically. In each case, the reasons for their pricing power are often quite self-evident. So to conclude, we introduce a simple new way to capture pricing power as a concept systematically and show that pricing power has provided a strong and consistent source of equity returns over the long run across multiple geographical markets across the globe. Hence, we have titled the article Pricing Power Everywhere to highlight the fact that not only is pricing power an important thematic concept everywhere, it has also been a strong source of smart beta risk premium. We believe that pricing power as a concept will only become even more relevant as we enter a new macroeconomic regime in which structural inflation makes a potential return. Investors everywhere can benefit from having some exposure to pricing power as a thematic factor in their portfolio. Now finally, a disclaimer. Invesco Limited has launched the Invesco Pricing Power ETF based on the Bloomberg Pricing Power Index, BPP US Index, under the ticker POWA, Power. So thank you very much for your time shared with us to listen to us telling you about our new research on pricing power. Please feel free to reach out to us and check out our website at bloombergindices.com. Thank you very much.
If you enjoy the show, be sure to leave us a rating and a review on your favorite platform. You can read investment research like you heard today by subscribing to The Idea Farm's free weekly e-newsletter at theideafarm.com. Thanks for listening, friends, and good investing.